Hi everyone, welcome to another session of financial analysis with Ted and myself, Moeed. Ted, how are you doing?
I'm good, Moeed. How are you?
Yeah, pretty good. It's a beautiful sunny day here in London.
It is,
Might be able to hear some birds chirping in the background.
and we can almost feel that lockdown is almost over as well.
Yeah,
There's
yeah, I
light
saw,
at the end
saw
of
a
the
lot of
tunnel.
children going out yesterday to schools, which was a nice change to see. Um, so today we're going to talk about natural brands foods. And just to let everyone know, all the viewers, this came as a request from one of our viewers. He left a comment in the comment section. And, if you want to do the same, please do so. Whether you are planning an interview with a particular company, or if you're thinking about investing in a business and you would like to look at their financial analysis, or even if you're planning to do business with a particular company. And we all know that knowing the financials tells the story about the company, and you'll be able to create a better dialogue and have a better hook and value proposition for the company. So whatever your interests are, if you want us to look at a particular company, leave a note in the comment section and we'll do a special video just for you. So Ted, let's talk about natural brands foods. What did you find out?
Absolutely. So, thank you very much, Moeed. So, once again, this was obviously a request from a comment. Natural Brand Foods, as the owner of the Naked Whole Foods, or the Naked without an E, Whole Foods brand. A little bit of investigation turns out they're owned by Loftus Biscuits. Lotus Bakeries. So we actually need to find the holding company that owns the brand. And sometimes you find that, the brand is a company, but it's actually part of a much bigger company. And we want to go and look at them and find out what's going on. So here is Lotus. And we're looking here at the Lotus Bakeries accounts. So just whiz down here. We'll do this a little bit slowly. So if we see here, you can see some of the brands, and hopefully some of those brands are looking familiar. If you've ever had a cup of coffee with the Lotus biscuits from the Lotus Bakery, and there's a little bit of ice cream going on there, more biscuits coming in, quite a variety of biscuits, and then we're into the Naked. So there's the Naked brand, which was our particular request, and then I'm thinking my kids certainly know this stuff very well. So lots and lots of different brands sitting under here, and worth looking at the overall performance. So let's whiz down to the actual accounts, and here are the financial statements, buried right down on about page 109 of the accounts. There's the balance sheet. We'll come back to the balance sheet in a minute. We're going to start with the income statement, so our trading account. And so the first thing we notice here is up at the top, we've got the turnover, 612. We're in thousands of euros. So this is about 612 million euros. And what they've got just below that is raw materials. Here's the raw materials. And then they've also got this thing called services and other goods. Now, I'm not sure exactly what services and other goods are, whether that's kind of more of the overheads supplies, or whether it's the cost of other services and goods that they need in order to be able to sell. So I've kind of made a leap, and for me, I've included it as part of my cost of sales, but I may be wrong there. So I've kind of said, look, all of this is the costs of running the business. These are the overheads, and these two are the cost of sales. And if we do that, we find they're operating on about a 40% gross margin, which probably sounds about right. We're selling, making the biscuits for 60 cents and selling them for €1, for example.
Okay.
And that comes down to the operating result, sometimes referred to as EBIT. EBIT is obviously earnings before interest and tax. There's the interest coming in here. There's the tax down here. So this is the earnings before interest and tax, sometimes kind of akin to the controllable profit. And we see down the bottom line, so they're making an EBIT margin of about 17%. It's pretty consistent year on year. And we see the bottom line, they're making a pretty nice healthy profit, about 12% net margin. And I think that 12% is actually a pretty good margin for these guys. So supermarkets typically will be around about the 4 or 5%. Facebook is a bit of an anomaly. It's a technical techwear company, so they're on about 30 or 40%. So I think 12% for a manufacturing business, got some good brands, so they can price at a small premium, but there's still a competitive element to it. They can't charge silly amounts of money for their products.
Okay.
So I think the only other thing I'd notice here is that they're paying some interest, and if they're paying interest, it means that they've got some debt, but the affordability of the interest looks no problem. So we compare these two numbers together in order to see are they easily able to pay the interest, and the answer is yes.
Okay.
So that's the income statement. If we go and look at the balance sheet, in the balance sheet, we see total assets of 812 billion. So this is the non-current assets up here, and what we see. So these top three lines are very big. This is all the manufacturing equipment. So this is all the kind of the plant and machinery that they're using to make the products, make the biscuits. This goodwill means that they have grown through acquisition. So goodwill arises, we always talk about this every time, Moeed, goodwill arises on the difference between the net asset value of the business you're buying and the actual price that you pay. So if you were buying this company, you'd be buying the net asset value, which is this number here, and you're going to be paying quite a bit more because, as we will see, it's trading at more than that in the marketplace. So that's what that goodwill is. It's the value. You can almost say it's the value of the brands, but that's a sort of a bit of a misnomer. And then they've got some intangible assets here, and we're not sure exactly what those intangibles are, but it might be a license, for example. They might have bought a license to make or distribute a certain product or something like that. So basically some quite big numbers up here, and what it looks like is that they are funding it through, some of that has been funded through debt. So they borrowed some money to fund the expansion, but most of it has been funded through the equity, and it's been funded through the retained earnings. So lots of profits being reinvested, a little bit of dividends being paid out. A little bit of share buybacks have been going on. They're buying their own shares. Lots of companies doing that. It's another way to get companies back, money back to the shareholders. So they've got some debt, but not too much debt. They've got a lot of equity, a lot of reinvestment going on. It's ticking a lot of boxes at the moment, Moeed.
Yeah, it looks healthy.
Just the other one we might want to look at when we look at a balance sheet is just comparing the current assets, which is this number here, to the current liabilities, which is this number here. And this is really looking at our affordability of our the current liabilities. Can we pay our bills on time? It's about 1. It doesn't look too bad. They've got some inventory in here. So if we run an acid test, which is excluding inventory, typically the least liquid of our liquid assets, then it's below 1. But these guys, interestingly enough, so if we go and have a look, if we look at their working capital requirement, what we find is that this number here is actually very high. Their trade payables, which means that if you're a supplier to these guys, don't expect to get paid in under 100 days. Okay, so they are using their negotiating power to pay their suppliers as late as possible. Big company, lots of negotiating power. So it's taking them on average just over 40 days to sell their product. That kind of makes sense, to make it and sell it. And it's taking them another 40 days, 45 days in order to collect the money in. Again, that sounds about reasonable, which means they're getting the money in on day 90, but then they're paying their suppliers on day 90 as well. So really, they're a cash equal business from their working capital requirements. So there's no strain there on their working capital from the business itself.
Okay.
hopefully that's all making sense.
Yeah.
So, you know, it's you know, it looks, it's a good company. You know, as I said, you know, the only potential issue is a low uh, a, a, a low working capital. So, you know, comparing you know, the current
Yeah.
assets to the current liabilities,
Yeah.
it's pretty close to one. They're sailing close to the wind, but it looks like they've got some pretty good you know, the pretty good management going on. And we can then sort of analyze these are numbers that we have to pay soon. So you'll notice, for example, the interest bearing liabilities. This is a pretty big number here. This is the short-term portion of the long-term debt, and in my experience, you'll notice these numbers are the same, which basically suggest that this company is refinancing its debt. So it's not paying back its debt. It doesn't have to get the money to repay its debt. It just refinances. It borrows over here to repays over here. Now,
Okay.
that's a guess from me. And the reason it's a guess, so let me just clear those drawings. The reason it's a guess is that they don't give a cash flow statement. Okay, so for some reason, there's no cash flow statement. And I could probably work out the cash flow statement if I wanted, but I didn't have time, unfortunately, and I'm too idle. So what we see here is their stock market value, which is, you know, they're trading at whatever that is, 4,400 euros per share. And what we're really interested in is the total market capitalization, which is this number here, which is 3.6 billion. So they're worth 3.6 billion. The net asset value is about 400 million. So this is effectively, it's all good. It's all goodwill. It's all, you know, you're buying the future income generating ability of this business.
Right.
The P ratio on these numbers is 43 times. If we actually look at the P ratio based on the 2019 numbers, it's 47 times. So that's a, you know, effectively, if you buy this company and it doesn't grow, then it's going to take you about 45 days to get your money back. Now it is growing, but it's growing at about 10% per year. You know, and 10% per year, I mean, it's good, but you know, I'm not falling out of bed for this. So that looks to me like, you know, it's expensive. You know, it's you know, it's a great company, but you know, we're not the only ones who've identified this as a great company. You can see the share price from well, that's over sort of the maximum year. So the share price has been tootling along, and then it's kind of been rising quite dramatically, probably as they've been expanding through acquisitions. So, you know, maybe there's an argument that they've got a good distribution network, they've got a good brand, good reputation, they can buy other brands, plug them in that, and they can grow through acquisition rather than organically. But you know, it looks high to me. Let's put it like that. I think there are cheaper companies out there.
Yeah. Interestingly, also the share price is certainly going to be a hesitation for a lot of retail investors out there. You know, 4,400 euros is not a small sum for retail investors.
And that's a good point. So often you hear about a stock split. So what a company will do is that they will do a split, and effectively, rather than having one share worth $4,400, you get 100 shares worth $44, for example, or euros in this example. So you know, if that happens to you as an investor, you're no better off, you're no worse off. But what you do have is additional liquidity, so it's much easier to sell your shares. And a good example of that is Warren Buffett's Berkshire Hathaway investment fund, which he's never done a stock split. And I think if you want to buy one share, you're going to be paying about $250,000. So, you know, the liquidity aspect becomes a little bit of a question. Now, Warren Buffett says, hey, I'm here for the long term. You know, I'm not interested in liquidity. If you don't like my fund, you can go and buy something else. But it's an interesting, you know, you raise an interesting point that, you know, if I was these guys and I wanted to start, you know, creating a little bit more volume, I might think about actually just doing that stock split, and therefore, you know, allowing a little bit more liquidity, especially if they're focused on retail investors rather than institutional.
And let's not forget, Tesla, sorry, not Tesla, Apple did that last year. um, where they split the stock. So okay, interesting. So all in all, it's a healthy business. It's running at a good margin. It has a lot of well-known brands. It's growing. Price seems a little expensive, um, and certainly one to watch out for. So yeah, really interesting business. Thank you for that, Ted. And hopefully we've answered our viewers' question around having a look at the business and looking at its finances. And look, if you have any questions about it, we'd love to hear your comments as well. Please share them in the comments below. Like, share, subscribe. You know, let's get as many people as possible watching these videos so that we can help as many people as possible get financially savvy and learn some business education here. So till the next video, Ted, thank you very much.
Yeah, no, thank you very much, Moeed. And as I said, you know, always nice to get a recommendation from somebody who's asking actively about stock. You know, I like to go and find out about new companies that I didn't even know about.
Great. Thank you, Ted.